Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It was the week in which Warren Buffett announced he would step down from Berkshire Hathaway after no less than 55 years in the top job. To mark the occasion, today we look at what remains by far Berkshire's biggest holding, that's Apple, and some comments and rebukes in recent days that could have significant consequences for its future. Arthur Sants is here to discuss, and he'll also analyse why Alphabet shares have slumped this week too. Our big read this week is on the future of flight. Mike Fahy is here to discuss how manufacturers think their vehicles could compete with Uber, and also how they are trying to forge a more sustainable future. To wrap up, we'll move from planes to trains and buses in the shape of National Express owner Mobico. It agreed a deal to sell its US school bus business the other week, but as Valeria Martinez will explain, that's not a silver bullet for the highly indebted company. We're going to start there with Apple. Arthur, there have been a couple of incidents, shall we say, in recent days regarding antitrust cases, regarding potential changes to Apple's business. Let's start with the one that affects it perhaps more significantly. You may disagree, and that's the issue it has been having with Epic Games and its App Store, and a ruling there from a few months ago and some comments this week. Then we'll move on to the Apple-Google relationship, which is also under scrutiny at the moment. But what's going on with Epic Games, first of all?
Hi, yeah. So the Epic Games thing has been dragging on for a while. It started back in 2021. Epic Games owns a game called Fortnite that's extremely popular, and they opened the case against Apple complaining about the App Store having a monopoly and charging this 30% fee, and at one point took Fortnite off the App Store, and it's been back and forth. Apple then won the original case, but part of the ruling was that they would require these apps on the App Store to be able to do out of App Store purchases. But when people tried to do out of app purchases, Apple then had these messages such as like warning them that if they went outside the ecosystem, it could be a threat. And also they continued to take a significant fee for these out of app purchases. And then recently, a judge has ruled against those practices, saying that sort of unnecessarily restricting app's ability to redirect users out to use out of App Store purchasing systems, and now has banned those practices that Apple were using. So in the short run, Apple is like, obviously there's a bunch of appeals and stuff going on, as there always is, but this could have a fairly significant impact on Apple's services revenue, and some people have already tried to take advantage of it. So Stripe, the payment system, has already like launched the service to allow people to more easily do out of app purchases, because before it was taking like multiple clicks to get through, whereas in-app purchases had one click through, although users would be able to save a lot of money. There's like two sides to this story. The Apple side, that hasn't been that significant a hit to the share price, although it could cost them some billions, although analysts generally don't think it's going to cause a massive issue because of the size of the in-app purchases, and also the fact that there's appeals to come and there'll be more negotiations down the line. Although it's tricky because the services, high margin services revenue was what was really keeping Apple's share price afloat, because iPhone sales have been pretty stagnant for a while, and a lot of analysts are making the case that services revenue, which are higher margin, are an increasing proportion of the total business, and that's been a sort of bull argument for Apple, while iPhone revenue has been pretty stagnant. But this obviously adds some headwinds to the discussion around that proportion of services revenue, and if that proves to restrict the amount of growth they're getting from services, then it will have an impact on their share price further down the line. But there's a lot of other things brewing around Apple at the moment, and with the trade wars, etc., it's sort of hard to pass out what is impacting, what driving which share price movement, etc.
Yeah, and this week there was a California judge said Apple willfully chose not to comply with its legal order to change US App Store rules as well. So there's clearly going to be some more back and forth on that front, at least in California, and another twist in the battle, if you will. But let's move on to almost immediately to the other big issue this week, which came in a separate antitrust case. Some comments by an Apple representative yesterday really hurt the Alphabet share price. Why don't we set the scene for those comments first of all, and also perhaps provide the context that this is all about for Apple trying to stay ahead of the changing face of search and things like that, by which I mean trying to keep with the times when it comes to artificial intelligence as well. So this is another thing the business has to deal with. And in fact, some of its comments yesterday suggest it might be changing its state of affairs with Google.
Yeah, so the comments actually seemed a bit unfair on Google. So they came in the Google antitrust case, and then Apple executive or vice president was giving testimony. And he said that in April, for the first time, the number of searches through Safari, which is the Apple browser, but which uses the Google search, which is part of the antitrust case because Google was paying Apple to be the preferred search engine through Apple products. And he was giving testimony, and he said in April, actually, for the first time, the number of searches through Safari had fallen, which seemed a little unfair on Google because they're currently being on trial for being a monopoly, but at the same time, the market is considering the fact that their monopoly might be ending. And then these comments came out about how they're losing market share, or at least in the specific case of Safari, the number of Google searches are going down, and their share price dropped 6%. So the regulator thinks they're a monopoly, but the market is now pricing them increasingly not monopolistically, because the assumption is that the reason why the Safari Google searches came down is because people are increasingly using AI chatbots to do their queries, such as ChatGPT, and Apple is considering using more AI chatbots as part of in the Safari browser to replace Google queries, which is why Alphabet's Google's share price dropped significantly. That's the concern.
This case is looking at remedies for, as they call it, to the antitrust case, because Google is going to have to pay up in some way, it does seem, whether that be via divestments or something else. We can get to that in a minute. But from Apple's point of view, okay, they were giving testimony here. It might be different. Who knows? It might be a slightly different angle to what they're saying to what they actually plan to do. But they're coming at it, as you say, from the point of view of thinking we need to make sure that we offer these AI services to our users so that our investors think we're at the forefront of this new trend as well. They've had some setbacks there, haven't they, in terms of providing access to a broader upgrade to Siri with AI features has been delayed, hasn't it? And there is some concern that they're not as far down the artificial intelligence path as some peers. But let's move on to Alphabet itself then, because clearly they get a lot of traffic, a lot of boost to their advertising business from this arrangement with Apple, because everyone with an iPhone uses Google by default for that reason. Whether that changes in future, we don't know. But what do you make of sort of the share price reaction and also the potential consequences were this to change?
I feel the share price reaction is overblown. Another thing that was missed in the testimony was that he said, the VP from Apple said that also iPhones might not exist in 10 years' time because of the impact of AI and the upheaval in the technology industry, which would clearly be bad for Apple if that was the case. But the share price didn't drop as significantly. Possibly the market's reacting because the Alphabet search story seems more plausible in the short term. And a lot of people have been saying that Google would be the most impacted by ChatGPT. An analyst I like called Ben Wrights at Melius Research has been saying this for a while and made the point that the verb is shifting. So people are increasingly saying ChatGPT things rather than Google things. And it definitely appears that the search business might be reaching its monopolistic peak, and there are other options coming, which maybe is about time because we've had this Google search bar as a way to access the internet for like 15 years now. So maybe it's about time that we had a different way of accessing the information on the internet. But it feels a little overblown, in part because Chrome, which is Google's browser, has a 66% market share versus Safari, which is like 17%. Because Chrome is obviously used on everyone's computers. I'm currently using Chrome while I'm doing this podcast, and also on all Android phones use Chrome as well. So Google still has a massive share of the browser market. And on top of that, last results, revenue from search was still growing. Partly it was because they were increasing the prices, so they were charging higher prices for advertising slots, and volume has been decelerating. So there are signs that volume of search is falling or decelerating, and it might be going elsewhere. But I don't think it's terminal, and it's definitely not going to disappear overnight. In part because they're just slightly different functions, and also ChatGPT is currently running on a massive loss. They're burning through cash, and it's currently don't charge that much given the service they offer. And a Google query is about 10 or 15 times less expensive than an equivalent ChatGPT query. So if you're just looking for a website, which is often what people do, or trying to do a short, just access some part of the internet, Google's still the best option and is much cheaper. So it doesn't seem that there's going to be a sudden overnight shift where the whole of Google's search business disappears. Like they're currently offering different things, and OpenAI is running at a significant loss. So it'll be interesting to see further down the line how much people are using ChatGPT for queries when they start charging them the amount they need to generate a profit.
They could end up using Google's own AI services for that. And of course, many people are via overviews, if nothing else, which appears at the top of Google nowadays. On the flip side, I suppose the market is always going to price in the marginal rate of change and changes to the growth profile and things like that. And so if you do see search coming off, that could still be a headwind in the near term. What about the antitrust case itself then? Because the Department of Justice this week proposed that Google should sell an ad marketplace and one of its ad platforms as part of these remedies. There's going to be, my understanding is September is when there'll be a decision made on what Google actually has to do, having already lost the case last year, what Alphabet has to do. What kind of impact would those suggestions have on the business? Sometimes we speak a lot about the advertising business still being a big driver for Google, of course. It has many strings to its bow, even on that front. But what's your thinking of how significant that would be? Because there's also been all kinds of things thrown out there about a breakup of Google, which obviously be a worse case scenario for the company and its investors, all the way down to having to change some behaviors, but not actually divesting anything, which is, of course, what the company says and wants to do. It's hard to read the runes of what the judges will say, but if it were to have to get rid of some of its ad tech, what do you think about that?
The reason why the antitrust case has happened is because they basically own every part of the advertising marketplace, including this AdX marketplace, which connects buyers and sellers of advertising space. But Google itself is also a big seller of advertising space, the biggest seller of them and Meta in the world. So the criticism is that they end up favoring their own themselves over other buyers and sellers on the marketplace, which is the criticism. And the regulator want them to sell the AdX marketplace. I guess it depends how much they are favoring themselves. If they are, it's hard to get a read of how much extra above market value they're getting from owning the AdX marketplace. They've already offered to divest it right in Europe, so maybe they aren't that concerned about it. It depends how much they were actually taking advantage of their position, which the regulator clearly seems to think it was significant enough to act. In terms of breaking up the whole business, whenever I've talked to fund managers, they've been fairly actually bullish about the idea, or at least not that bearish about the idea, in the sense that the sum of the parts of the business still might be a significant amount of value. So when you talk about Amazon, there's lots of people that think that AWS, for example, is worth much more than it's currently being valued at. The same with Google Cloud. A lot of analysts now are saying with the threat to search, they wish just Google Cloud was its own business, because that's by far growing at 30%, its margins expanding. It's by far the most profitable and growing part of Alphabet's business now. So in terms of the breakup, probably wouldn't be preferred, but actually it's not possibly as disastrous as it might seem on first glance, in terms of for shareholders.
Mm. The proposed sale of the ADEX business made to European regulators last year, as you say, that was rejected by European regulators, though, too, in their own separate antitrust investigation as insufficient, albeit that investigation is far less further along than the US one and currently less of a risk to the company. But as you say, it might imply they would be happy to do that. Clearly, they suggested it as a solution, so it wouldn't be that big a blow to them if this is one of the outcomes. But let's talk about some of the other aspects of the business, though. You've talked about the cloud. There are other things too that Google has. Clearly, as with most of these tech giants, it has its fingers in many pies. But there are some of those businesses that are quite advanced and do, if not provide anywhere near the same revenue as the advertising search business, do provide increasingly attractive prospects, perhaps.
Yeah, so I was looking at the numbers just before the podcast, and Google Cloud, which I mentioned just before, is the fastest growing part of the business. And back in 2022, it was around 8%, and now it's up to around 15%. So because Google Cloud's growing faster than the rest of the business, it's making up a larger proportion, and operating income is growing even faster than that because they're getting economies of scale from all of the AI servers they've purchased. And CapEx is continuing, and most of that CapEx will be flowing into more AI chips and NVIDIA chips. But also, Google has partnerships with Broadcom, so it's developing its own AI chips. They call them tensor processing units or TPUs. So NVIDIA chips can be used for lots of different things like crypto mining and video games, but they just happen to be used for AI. The Google chips are specifically used for AI and apparently are much more, or at least significantly more efficient than the GPUs, although they're less versatile. But Google apparently is the leader in terms of developing its own AI hardware. Well, two of its employees won Nobel Prizes last year for chemistry at DeepMind for their protein structure work. So clearly there's loads of extremely impressive research and high-tech work going on at Google that is getting lost amongst the concern around the search business because search is at the moment, such a large proportion of revenue. It's also got Waymo, which is the autonomous taxi business, which now, if you go to LA or San Francisco, there's no drivers in the cars. They'll just drive you around. And Tesla is currently valued at 800 billion over its potential AI taxi services. Whereas maybe in that context, you could say that Waymo is possibly a little undervalued given the hype around. If they had sort of half the hype that Tesla does, then maybe Waymo would be getting a more favorable valuation in the market.
Yeah, I mean, as you say, Waymo, it does seem to be ahead of Tesla on that front, and it's not really a moonshot business at this stage because it is in operation and is working and does seem to be quite popular. There's other aspects such as the quantum computing arm, which is a bit more pie in the sky still for now, but it certainly has some potential. As all this perhaps implies, given the sell-off in Alphabet shares this week and recent weeks, you're quite bullish on the valuation and conversely a little bit more skeptical when it comes to Apple.
Yeah, so Alphabet is trading at diff forward P. It's trading at a discount to the S&P 500 and is significantly cheaper than most of the other big technology companies, despite what we mentioned earlier with the sort of quite exciting technology and its significant involvement in AI. Yeah, Apple, I'm a little bit more skeptical of. iPhone sales have been pretty stagnant for a while, and even its most recent iPhone release did fine, but it wasn't. It's sort of losing the hype now around each of its subsequent hardware releases. And just in general, we've had a touchscreen iPhone since like 2007 and haven't had a disruption of the industry, but you'd expect at some point, I can't predict the future, but it feels like at some point we're going to move on from touchscreen phones in terms of the way we communicate with each other. And as we mentioned earlier, they are sort of struggling to find their place a bit in the AI universe. They don't own any GPUs, so they can't train their own models or rent the GPUs out to other AI companies. They also they have partnerships with OpenAI and partnerships with other AI companies, but don't also have any proprietary models of their own, or if they do, they're not public. And So they're slightly struggling to find their place in this new technology universe, yet their valuation is still very high. And it's difficult to see how they're gonna have the growth that justifies that valuation. On top of that, you can throw in all we managed to actually not talk about trade wars, I think, once so far on this podcast, but you could toss in the fact that it makes almost all of its hardware in China on top of that story, and it doesn't add to a positive picture around Apple. So I would say out of the two, I would be probably buying Alphabet over Apple.
Indeed. And plus, of course, if to return full circle to the browser issue, if that arrangement were to be changed, Alphabet would lose the Safari default browser status, but Apple would lose the 20 billion a year it gets paid by Alphabet for that status. So it's not a one-way street there. We've got to move on now, though. We're going to talk about our big feature of the week, which is all about aviation and the future thereof. Mike, you have covered this for us as our expert in the space. Why don't we start by looking at, to me at least, when people say the future of flight, you think of sustainability and things like that, and we'll come to that. That's definitely a big part of it. But another aspect that is really, I don't want to say taking off, but I'm going to, or trying to take off, is
It's hard to avoid the pun.
yeah, is the vertical takeoff and landing
Yeah.
aircraft. Can we say a bit about this space, this subsector, what they're hoping to do, and what they're trying to disrupt?
And similarly, with Arthur mentioning Google and the autonomous taxis, this idea of, as they've been dubbed, flying taxis has been around for quite a while, but it does seem to be at a stage where, if you believe the companies themselves, is almost imminent. So these eVTOLs, there are many different types. Some of them look like planes, some of them look like helicopters, some of them look completely bizarre, but they're kind of, the common denominator is that they have these quite light but powerful motors that lift these vehicles up on takeoff and landing, as the name suggests, and allow them to hover. They are quite silent when compared with helicopters, and you mentioned disruption, we'll come to that. And the other thing about them is that you mentioned use cases. I think that helicopter market will be one where they are, or it is one they are actively targeting at first. The argument is being made that these things are powered by multiple rotors rather than just the one main one. They're safer, they are less noisy, and they are a lot more economical to run as well. But there are a bunch of other use cases. So far they're reasonably limited in terms of range. You're talking about like 30 miles at the lower ends, up to 200. Although some have certainly been experimenting with hydrogen fuel, which could take them a lot further. And I think that experimentation is important because that increases the use cases, particularly in terms of military use, uh, for carrying troops to and from, for surveillance, for all kinds of things. That's one use. Freight, aerial kind of photography, etc. There are a bunch of use cases, but in the near future, particularly with the idea of raising revenue, it's that helicopter shuttle market really that they're looking at.
That kind of premium airport to and
Yeah.
from trip, which they say they can do at a more cost-effective
Yeah.
rate.
Currently, it costs anywhere between, say, $4 and $11 a mile to use one of those helicopter shuttle services between Newark and downtown New York, say. And the eVTOL operators are pricing a service kind of similar to the higher end Uber Black type range of $3-4.
Yeah, so that's clearly a potential. We'll come to some of the regions where they are operating in a moment, but what are some of these companies? Because there has been a bit of a, as in many sectors, there has been a bit of a thinning of the herd in recent years.
Yeah, so I spoke to a bunch of these, or a few of them, at the Farnborough Air Show last year, and one of them, Lilium, was the big hope in Germany. It had a presentation titled "Electric Flying is Almost There," but sadly it didn't come quickly enough for them. They went into insolvency earlier this year after a scrabble around for funding. All of these companies, although they may sound to listeners from what we've said so far to be a little bit flaky or pie in the sky. They, there are kind of very near-term deadlines for a lot of them, but there's also been some significant backing by some major funders. I mean, Lilium, we just mentioned, was backed by Tencent. It had backing from Honeywell, another German company, Volocopter, which folded in December, was backed by Mercedes-Benz, by BlackRock. So they've all had kind of top-class funding. The issue clearly is that a lot of that funding came in 2020 to 21 when markets for these kind of technology pre-revenue businesses was a lot easier to raise than it is now.
There are some survivors, though, including one backed by Scottish Mortgage, a small part of its portfolio.
Yeah, I would say of the two, well, there are 5 main listed operators that we focus on in the article. And of that, there are 2 clear leaders, both of which are kind of Silicon Valley startups. Joby is one and Archer is the other. Joby is the one that is backed by Scottish Mortgage. I did speak to Scottish Mortgage. Not a lot of what they said ended up in the piece, but their appreciation of Joby over peers is the fact that it tried to be, as Scottish Mortgage's manager Tom Slater described it, Boeing plus British Airways. So it's not only making these vehicles, it wants to operate these services within cities around the world. It wants to operate a range of other services, but it also wants to be the platform through which people make the bookings as well. There are people involved in both Joby and in Archer who were in Uber Elevate at one stage as well.
And it's the Middle East where there's been some early inroads made by these companies.
Yeah, both Joby and Archer are targeting launches in the Middle East from this year, supposedly. Whether that happens or not, I have my doubts. I think regulators, or the regulator in the United Arab Emirates, where both of these want to fly from, has in the past tended to follow the lead of the Federal Aviation Authority in the US, and that has not certified any of these to fly just yet. But Joby's talking about getting some sort of temporary dispensation from the local regulator and running services from Dubai Airport to 3 different points in the city. And Archer has already done a deal with AD Aviation, which is this company owned by two Abu Dhabi hedge funds, which runs helicopter services, it runs cargo services, and it runs some other services as well, both for military and for civilian markets. And it's that military market which may allow them to start a little bit earlier. Obviously, for military flights, the certification doesn't need to be as rigorous as passenger flights.
Let's move on to sustainable aviation fuel. And there's a similar trend happening there again in terms of a smaller pool of players than there once were, as does happen with a nascent technology. But can we say a bit more about what's been happening there?
We can, and certainly when you look at the future of, I don't know whether you call them conventional craft or certainly long-range aircraft, because these eVTOLs, TOLs, as we've already said, are limited in range. So for that conventional aircraft market, for any distance longer than 300 miles, electric isn't there yet, and they have looked at hydrogen, and it seems like hydrogen isn't there at the scale or the price that will allow for long distance flights, certainly any time in the interim. So sustainable aviation fuel, SAF as they shorten it to, seems to be like the only game in town, really. And even that, there are issues with scale up. The advantage with sustainable aviation fuel is it can be just plugged into existing infrastructure. There are no major changes that need to be made to engines. The disadvantage is just that there's not enough of it. There are mandates both from the EU and the UK already from this year, I think, in the UK. Airlines are supposed to use 2% of SAF in all of the fuel by 2030. In the EU, airlines should be using 6%, and in the UK, I think it's nearly 10%. Now, airlines signed years ago There was a deep dive done into this by RBC Capital Markets, which went through the supply and demand, and there have been loads of offtake agreements signed by airlines with SAF providers. The difficulty is, as you said, this is a nascent technology, and some of those providers have fallen short, and there just isn't the amount of SAF available currently to meet mandates. The airline industry is, certainly in Europe, is lobbying quite hard to have these mandates postponed as well at the moment.
Do you think we'll get to a situation in even the foreseeable future at some point where this will become the default fuel source? I mean, what do we need to do to get there?
I think eventually it has to. Airlines are possibly quite rightly complaining about both the availability and the cost. SAF at the minute costs about 3 times the amount that kerosene does. And the European airlines are saying that if we are made to stick to these mandates, then we're just not going to be competitive on a global level. You know, they're competing with American airlines, they're competing with Middle Eastern and Asian airlines. And if they are having to take considerably higher costs on in developing SAF, then it is going to be an issue for them. However, I don't see how, without some form of mandate to develop this market, the scale is ever going to be there for that cost to come down to a reasonable level. And given that there are no other alternatives, unless the only other option is more efficient engines, which they're all working on anyway. But aside from that, if it's the only way for the industry to decarbonise, really.
Speaking of engines and the industry as a whole, you mentioned Boeing earlier on. Just to wrap up, what are the big plane manufacturers doing on both of these fronts? How involved are they?
So with the hydrogen market or alternative fuels, they're all developing kind of technology. Well, they'd all tried to develop something for hydrogen. Boeing was a little circumspect on, and it seems rightly so, because Airbus has spent quite a lot of time on a demonstrator plane called the Zero E, which initially it was looking at powering directly from hydrogen. That seems like it's too unstable, so they're now using hydrogen fuel cells. But they had a goal of getting this to market by 2035, and already earlier this year they scrapped that goal. In terms of that eVTOL market, they're all keen on that. Boeing has backed a company called Whisk, which is one of the many private operators in this space. There are thousands of companies trying to come up with these eVTOL designs, but as we mentioned, the funding has sort of just coalesced around the ones that are further down the line. So yeah, Boeing overtook Whisk in 2023, and Whisk and Archer had also had some form of intellectual property agreement, which ended up in a lawsuit. And through that lawsuit, Boeing now owns a chunk of Archer. In Airbus's terms, they had been trying to develop their own kind of next-gen craft. But again, having spent money on the R&D side of this, they decided earlier this year that the batteries weren't to the scale that they felt that they could work with just yet, and they've basically dropped that project. So if we're finishing, it's probably useful to finish on a valuation case and that there are a couple, like a Chinese company called Ehang, which is now kind of broken even on a cash flow basis. Archer is selling units, so it is bringing in revenue, and you would think that within the next year or so, if these flights finally do get off the ground, as you said, there will be more revenue, and on a profit basis, a few are looking to break even by 2029-ish, 2030. So from an investment point of view, it's still a punt, obviously, because these companies are still loss-making. However, one of the analysts pointed out that if Airbus and Boeing don't really have a viable position in this market yet, there is the potential for them to sit on the sidelines, see which one emerges, and then just buy that. And if it costs them a few billion quid, then so be it.
Indeed. Well, there's a lot more information in the feature, so do pick up a copy of the magazine, have a look at that online if you have an interest in the future of flight. For the final section of today's show, though, we are returning to the ground, looking at a Mobico, which, as we mentioned earlier on, has finally offloaded the US school bus arm that it's been trying to do for a couple of years now. As you can probably tell from the near halving of its share price over the last month, though, Valeria, it didn't exactly go as many people had hoped. What can you say, just as a general outline, about the context for this divestment?
Yeah, so as you said, this was meant to be a major deleveraging event for Mobico. It's been going around 2 years that they said they were selling this, and just starting with the price, it came below the valuation range that Jeffries had put, about between 650 million and 1.6 billion. It was 608 million. But the reason why the share price is halved is not so much about the headline price, but about what the sale is actually doing to Mobica's debt. So it's not really going to move the needle. This is because once you account for lease repayments, deferred capex, transaction fees, the group is only pocketing about 365 million and 385 million in upfront cash. And then potentially, depending on performance, another 70 million in earnout payments. But then of these upfront proceeds, a big chunk of it is going towards legacy lease liabilities, and then it's also retaining 65 million of historic claim liabilities. And then on top of that, you have separation costs, which the company hasn't yet quantified. So what that means is that on a covenant net basis, which is the metric that the business uses, is not really going to do anything. So it's expected to be neutral, which is obviously very disappointing, and as it was meant to, you know, move the needle a little bit on debt. So in that respect, it's been a failure.
Mm. And the backdrop to all this, of course, is the business. The National Express owner, as you would expect from that kind of business, does have a lot of debt, which it amassed during the pandemic, and it's been a sort of a slow, grinding recovery since then. It's still got this big debt burden to deal with, clearly. In the context of that, we should ask what the next catalyst will be, or what could happen in a worst case scenario, i.e., what is its debt situation currently? When do the big refinancings come due? And what are people concerned about in that context in terms of the timeline?
So you can look at it from two ways. The way that, as I said, the way the company sort of measures its covenant, so its net debt is excluding this 500 million hybrid bond that it has. Obviously, that measure also excludes lease liabilities. So on this measure, the leverage ratio is at 2.8 times EBITDA. The company had previously said that it was going to take this ratio by to 1.5 to 2 times by 2027, and now it's sort of saying that it will get to that deadline, to that target over time, which is quite concerning if you think about some refinancing that the company has in the next couple of years. There's nothing looming or maturing in the next year. But if you think about this hybrid bond, it's perpetual, so it doesn't actually mature. But there's this deadline of February 2026 when the company has to either redeem it or repay it, or refinance it. And obviously, with the U.S. school bus sale not really doing anything to its debt burden, it's probably not going to be able to do that. Peel Hunt estimates that this coupon that they have will double if they don't pay it at sort of current gilt rates. And then there's another loan. It's an off-market loan worth more than 230 million that it's maturing in 2027. I mean, the company spent almost 90 million in interest payments last year. So if you think about that, that'll probably go up quite significantly.
It does have other potential deleveraging options, of course. It is a business in a number of countries and geographies. None of them inevitably will be a perfect solution, one imagines, but there are some options that it could look at.
There are some limited options.
Right.
The company has said that it's looking at other leveraging options are under consideration. Hasn't been really specific beyond just improving its operations and just using cash generation to repay its debt. That's what analysts call sort of organic deleveraging. So it's pinning a lot of its hopes on ALSA, which is its Spanish subsidiary. It's been doing quite well. It's generating quite a lot of cash, and results last year came ahead of expectations. But the wider business is still struggling. So analysts don't think that this is going to do much, and that the company will have to look at other things. So, in terms of other things, it could sell another division, but its North American transit and shuttle business, We Drive You, it could be sold, but that would mean losing a high return growth asset. They probably wouldn't be able to secure a really attractive valuation for its UK business as it's still recovering. And then the German business is loss making. So that essentially leaves it to a potential equity raise. But even that could be a tough sell given that it doesn't really have a very clear investment case at the moment. Maybe private equity could swoop in, but yeah, I mean they're not really troubled by leverage. But the bottom line is Alsa seems like the main bright spot at the moment for them.
We should say they do have, I think it's about 800 million in cash and undrawn facilities, as you say in the piece. So they're still able to meet all the interest costs quite comfortably at the moment. And there are these divisions doing well, like Alsa. The UK division, there are signs of life there as well in the second half of last year. So recovery is coming through there. So it's not a terminal situation. There are some positives. What do we think about the valuation, perhaps in all this context, because it has fallen a long way in recent weeks, and we've spoken about a lot of the negatives and the shadow overhanging the company, but when something falls that far, it's not a kind of cut and dry situation.
No, absolutely not. I mean, the company looks very cheap, at least optically. It trades on 3.4 times forward earnings, but Palmer Liveram has pointed out that this overlooks the losses in the German rail division, and with no clear sort of options to deleverage, I think this is reflected in this discounted valuation. So yeah, things are improving. Cash flow is improving. Alsa is doing great. We're starting to see a bit of a turnaround in the UK business, and there's also potential upside if negotiations with German public authorities go well. They're still in process at the moment, but just thinking about rising debt does make us a little bit nervous. So we did downgrade it to a sell recently.
What about, to finish, there has been a change at the top, as you might expect with all this going on. The CEO has gone, search for a successor has begun. In the meantime, a fairly safe pair of hands has taken over the ship insofar as that is possible.
Yeah, so he used to run what it was called National Express actually 20 years ago. So investors have sort of welcomed this. I have spoken to a couple of analysts, and they both suggest that the company should poach Christian Schreier. He's the former CEO of previously listed transport group Go Ahead. This company faced similar problems to Mobico a few years ago, and under his leadership, they resolved them, and then the company ended up being taken private in 2022. I'm not entirely sure what he's doing now, but could be a potential option.
Indeed. Well, that is a story that is going to play out, as these stories tend to do, over the next few months, and we will keep you posted about that. For today, though, we have run out of time. We've come to the end of the show, so thank you very much to Valeria, to Mike, to Arthur, and to our producer, Maddie Apthorpe. We will be back next week with another Companies and Markets show.